Hello, welcome to this lecture. Now we will start looking at the common Forex terminology. Now, the first thing that most people will probably very quickly get to know or see in Forex is the bid price, the ask price, liquidity, long, short, and pip. Those are very common terminology used in trade and in execution of trades. So let's start with the bid price. The bid price is the price you can sell a currency pair to a dealer. The ask price is the price that you can buy the currency pair from a dealer. Then liquidity. The liquidity is the ability or the ease of buying an instrument. And in this case, we're talking about Forex or FX. Long. Long is buying a currency pair. Short. Short is selling a currency pair. Many of you will, in the course of your trading or execution of trades in foreign exchange, will always come up with, we will always hear these expressions, to go long and to go short. So now you know what those mean. Then we look at the pip. The pip is the smallest unit that a price can change. In some ways, you can say that it is the fifth significant digit in a quote. It's if you've got 1.7001, the pip is the last one or the last unit there. So it's the fifth significant digit in this particular quote. Obviously, for some currencies where you've got bigger ones, it's just really the fourth decimal place in the quote. You'll always notice that the currency pair will always be to about 4 places of decimal. You've got 1, 2, 3, 4 places of decimal, of which the pip is the smallest unit. The smallest unit a price can change. Now let's bring this home for some of us. Say, for instance, you wish to, most of us would have looked in some way, without realizing it, would have looked or have dabbled in some way with foreign exchange or have come across it. An example would be, say you are living in the US and you want to go to, say, Switzerland, and you've got some dollar denominated currency and you wish to go to Switzerland. Obviously, you've got to now change that currency. Now, the US dollar is called the USD. For short, the Swiss franc is CHF. So in that sense, the pair that you'll be looking for, or you would have been asking a dealer, maybe at the airport, to change money for you, would have been the dollar Swiss. So those then will now be what you, because we talked about currency pairs, so this is now a currency pair, USD CHF, the dollar Swiss. That is a currency pair. So the next thing is that you approach the dealer, and then you will want to hand over your cash for the money which is now denominated in dollars to be swapped into Swiss francs. And what will then happen? This is perhaps there's a loose analogy here. Is that in terms of the foreign exchange market, what you're now looking for is a currency pair of the dollar Swiss, the USD CHF. Now, there will be 2 prices that will be given to you. One is 1.1569 and the other one is 1.1571. Now, this is not the current price for the dollar Swiss in any way. These prices do change and fluctuate all the time. So it depends at the time what the price for the exchange or for the currency pair is. So this is an example. It's not the current price. So you're given two prices there. Now, I think where the analogy does end is if you were at the airport, they won't quote you to the 4 significant, to 5 significant figures or the 4 decimal places that you see here. But in the FX market, it goes to this level of detail, to the pip, which we talked about. So the first one is the bid price, and the second one is the ask price. Again, if you remember, we defined the bid price as the price that you can sell a currency pair to a dealer, and then the second one is the ask price, and this is the price the currency pair. This is the price you buy the currency pair from the dealer. So depending on which way it is, if you're If you're buying, obviously you're now is the ask price. If you're selling the currency pair to a dealer, it is the bid price. So let's look at these prices in FX terms. So you've got two prices there. The bid price, the first one there, which is the price that you're going to sell the currency pair, and the ask price, the second one, is the price you can buy the currency pair from the dealer. Now this leads us to two other definitions or terminology that you'll be coming across. So we've got a currency pair, the dollar Swiss, the USD CHF, which is the dollar Swiss. Now there are two new terms there that you'll probably come across, and that is the base currency. The US dollar will be the base currency, whereas the Swiss francs will be the counter currency. So the first one is the base currency, and the second one, the Swiss franc, is the counter currency. And this is always the way it will be presented in terms of the FX market. So you've got dollar Swiss, and then you have two prices there. The first one is the bid price, the second one is the ask price. So it's the base currency, counter currency, the bid price, and then the ask price. Now what does this mean in real terms? It means that for $1 of USD, you will now if you're buying from a dealer, you'll be getting 1.571 from that dealer of Swiss francs. So in a sense, $1 gets you 1.1571 Swiss francs. We will look at the price again. The pip is is 1/100th of 1 cent, and that is the very last figure. You've got 5 significant figures or 4 places of decimal, and the very last one there is the pip, and it's 1/100th of a cent. If you were if we go back to our airport analogy where you're buying or trying to exchange currency, you probably get the first 3, 1.15, but for in the FX market, it goes down. It goes to 5 significant figures, or the fourth place after the decimal figure, and that gives you the pip.